History doesn't repeat itself, but it rhymes. That's the saying you've probably heard 1,000 times, usually from someone trying to sound wise without offering anything useful. But when it comes to financial crashes, history doesn't just rhyme. It plagiarizes entire passages word for word from previous disasters, while changing only the superficial details. The names of the banks dot the specific financial instruments. The specific financial instruments, the exact date on the calendar, but the fundamental pattern remains so consistent, so predictable, so brutally mechanical that if you understand what happened in 1929 and what happened in 2008, you can look at 2025 right now and see the exact same story beginning to unfold in real time, playing out with the same characters wearing different costumes, the same plot points arranged in the same sequence, the same inevitable tragedy rushing toward the same devastating conclusion. September 3rd, 1929. The Dow Jones Industrial Average hit its all-time peak at 381.17, and across Wall Street, from the trading floors to the brokerage houses to the newspaper financial pages, the consensus was unanimous. The market would keep climbing forever because this time was different. Because America had entered a new era of permanent prosperity where the old rules no longer applied, where technology and innovation and modern financial engineering had permanently abolished the boom-bust cycle that plagued previous generations. And ordinary Americans believed this so completely that they borrowed money to buy stocks on margin, putting down as little as 10% of the purchase price while borrowing the other 90% from brokers, who were themselves borrowing from banks who were confident that stock prices could only go up, creating a towering pyramid of leverage where everyone owed everyone else money that didn't actually exist, except as numbers on paper representing the theoretical value of stocks that were themselves overvalued by every traditional metric. Less than 2 months later, on October 24 Black Thursday, the entire structure began to collapse when selling pressure overwhelmed buyers and margin calls forced investors to liquidate positions to cover their debts, which forced more selling, which triggered more margin calls, which forced more selling, cascading downward in a negative feedback loop that nothing could stop, because once everyone simultaneously tries to exit through the same door, the door disappears. By July 1932, the Dow had plummeted 89% from its peak, wiping out the life savings of millions of Americans who had believed the promises of permanent prosperity. And the crash didn't just destroy wealth, it triggered a depression that lasted an entire decade, put 1 in 4 Americans out of work, created bread lines in every major city, destroyed thousands of banks that held people's deposits, and fundamentally reshaped American society in ways we're still living with today. Here's what most people don't understand about 1929. It wasn't the crash itself that created the depression, it was the policy response. Because when faced with a collapsing economy, the government and Federal Reserve made every wrong decision possible, raising interest rates when they should have lowered them, cutting government spending when they should have increased it, allowing banks to fail when they should have rescued them, essentially doing the exact opposite of what economic theory would later prove was necessary, turning a severe recession into a catastrophic depression that wouldn't end until World War II forced massive government spending and industrial mobilization. Fast forward to 2008, and the pattern repeats with eerie precision once again. The financial establishment proclaimed that a new era had arrived where sophisticated financial engineering and modern risk management had permanently eliminated the possibility of systemic crisis, where housing prices could never fall because they had never fallen nationally before, where mortgage-backed securities rated AA by credit agencies were as safe as treasury bonds, where Wall Street had figured out how to package subprime garbage into investment-grade securities through the magic of derivatives and mathematical models that no one actually understood, but everyone trusted because the models said they were safe. The crash, when it came in September 2008, followed the same script as 1929, over-leveraged. Institutions betting on ever-rising asset prices suddenly faced a liquidity crisis when those prices stopped rising, triggering margin calls and forced liquidations that created a cascade of selling that overwhelmed any attempt to stabilize markets. Except this time the crash happened faster because modern electronic trading and interconnected global markets meant that panic could spread at the speed of light rather than the speed of telephone calls and telegraph messages. Lehman Brothers collapsed. Bear Stearns disappeared. AIG needed a government bailout of $182 billion. The stock market lost 54% of its value in 18 months. The housing market that everyone said could never crash lost 30% of its value nationally and 60% in some markets. Unemployment spiked to 10%. Millions of Americans lost their homes to foreclosure. Retirement accounts that families had spent decades building evaporated. And once again, ordinary people paid the price for the reckless speculation of financial elites who walked away with golden parachutes while everyone else walked away with nothing. But here's where 2008 differed from 1929. This time policymakers had studied the Great Depression and learned its lessons. So instead of repeating the policy mistakes of the 1930s, they did the opposite. The Federal Reserve slashed interest rates to near zero. The government passed massive stimulus packages. Regulators rescued failing banks instead of letting them collapse. And while these interventions prevented a complete economic meltdown and shortened the recession compared to the Depression, they also ensured that the people responsible for the crisis never faced consequences, that banks became even larger and more powerful than before, that wealth inequality accelerated as bailouts and easy money inflated asset prices, benefiting those who already owned assets, while doing nothing for ordinary workers, and that the fundamental vulnerabilities in the system were never actually fixed because fixing them would have required restructuring an economic model that benefits the people who control policy. Now look at 2025 and you'll see the same pattern unfolding again with the same beats, the same narrative arcs, the same warning signs flashing in sequence like a checklist, being methodically checked off box by box. Consumer confidence is collapsing. The Conference Board's index just hit 97.4, the lowest reading since August, driven by Americans' deteriorating views on jobs and fears about the future economy. Manufacturing activity is contracting. New orders are falling. Inventories are building, suggesting businesses expect demand to weaken further in coming months. The labor market is softening. Job creation in August came in at just 22,000, dramatically below the 75,000 that was already considered weak. And the quits rate has fallen from 3% in March 2022 to 2.2% now, which means workers feel too insecure to leave their current jobs even if they're unhappy. Always a reliable precursor to broader economic weakness. Credit markets are flashing warnings. A J.P. Morgan model tracking 8 recession indicators is showing a 41% chance of a credit recession, its highest reading since 2020, and UBS analysts are calculating that recession probability has hit 93%. The most dire forecast issued by a major Wall Street bank in years. The leading economic index from the Conference Board, which compiles 10 forward-looking indicators, including stock prices, manufacturing orders, consumer expectations, and building permits, just posted its largest monthly decline since April 2024, and the index has now been negative for 7 consecutive months, which has historically predicted recessions with reliable accuracy. The yield curve remains inverted at 23%, meaning short-term interest rates exceed long-term rates. And while an inverted yield curve doesn't cause recessions, T has preceded every recession since 1969 with only one false positive. Political and economic chaos as accelerating tariffs are dragging down GDP growth while simultaneously creating inflation pressures, the worst of both worlds. And with a national debt now exceeding $38 trillion and annual deficits running above $2 trillion, the government has little fiscal room to respond to a crisis with stimulus spending the way it did in 2008. Stock market valuations are at levels that historically precede major corrections. The Shiller CAPE ratio measuring price to earnings over 10-year periods is above 30, a level exceeded only briefly in 1929, 2000, and right before the 2022 correction, suggesting that even modest earnings disappointments could trigger significant selling. And just as in 1929 and 2007, the narrative from Wall Street and financial media is that this time is different, that artificial intelligence and technological innovation have created a new paradigm where old valuation metrics don't apply, that the economy is fundamentally strong despite all the warning indicators suggesting otherwise, that any concerns about recession are overblown pessimism from people who do and understand the resilience of modern markets. This is the pattern that repeats, not because history is mystically cyclical, not because some cosmic force compels economies to crash every generation, but because the fundamental incentives and structures that create financial crises have never been reformed. Because the people who profit from speculation and leverage are the same people who write the regulations that supposedly prevent speculation and leverage. Because the political system rewards short-term thinking that ignores long-term risks. Because every generation enters the market believing that somehow the rules have changed and permanent prosperity is finally achievable if only everyone keeps believing and keeps buying. The crashes happen because they must happen, because you cannot indefinitely sustain asset prices that rise faster than the underlying economic fundamentals that supposedly justify those prices, because leverage amplifies gains on the way up, but catastrophically amplifies losses on the way down, because once enough people realize that current prices are unsustainable and start selling. It triggers a self-fulfilling panic, where the act of selling drives prices down, which validates the decision to sell, which causes more people to sell. And no force on earth can stop that cascade once it begins. The people telling you that 2025 is different, that the warning signs don't mean what they've always meant, that recession fears are overblown, that markets can keep climbing indefinitely. These are the same people who said the same things in 1929 and 2007, the same people who profit from convincing you to stay invested while they quietly hedge their own positions, the same people who will walk away wealthy after the crash while you're left holding worthless assets. History is not subtle about this pattern. It repeats with such mechanical precision that anyone paying attention can see it coming. In 1929, ordinary Americans ignored the warning signs and kept buying stocks on margin until the crash destroyed them. In 2008, ordinary Americans ignored the warning signs and kept buying overpriced houses with subprime mortgages until the crash destroyed them. In 2025, the warning signs are flashing again, unemployment rising, consumer confidence falling, credit tightening, leading indicators declining, valuations stretched, debt levels unsustainable, and once again, most people will ignore them because they want to believe that this time is different, that they've found a way to get rich without risk, that the party can last forever if everyone just keeps dancing. The crash is coming, not because anyone wants it, but because the mathematics of the system ensures it, because the pattern always completes, because history doesn't repeat, but it rhymes. And right now, in 2025, it is rhyming so loudly that anyone willing to listen can hear exactly what is coming next.